not a whole lot of growth beneath the bottom line. What do you think?
Right, so the earnings per share was a beat. However, if you remove the tax benefits that they received, we'd be looking at $1.13 versus the $1.21 that was reported. To your point on the revenue was a miss. That has become a common theme for Wells Fargo and the driver of lower earnings per share estimates for the last couple of years. Non-interest income or the fee-based revenue was the major concern here. Revenue was below expectations for service charges on deposits, card fees, trust and investment management fees. Some of that is driven by the background, but some of the stuff is specific to Wells Fargo.
Right, I was just going to ask, how much of this has to do with fallout from the fake account scandal and how they've struggled to clean up reputation and have an impact among consumers, and how much of it is other problems?
Yep, absolutely. Their fundamentals since the announcement of the account opening fraud have been inferior to peers, and that's been causing them to produce below peer revenue growth, below peer loan growth, and that's what's driving the pre-tax numbers for Wells Fargo. Obviously, with share repurchases and a lower tax rate, they're able to grow earnings per share, but outside of those items, it's been challenging for them to grow earnings per share.
I always look at Wells at the mortgage business, one of the biggest, if not the biggest. It looks like the business tumbled, fees down, origination, service. How much of that is seasonal and how much it reflects a weak housing market?
Right, so the fourth quarter is seasonally weaker for Wells, and that will be the case across the board during earnings season for banks with mortgage exposure. In the quarter, with the rates coming down on mortgage rates, the expectation is that MSR valuations came down. So there was a bit of a hit because of a write-down of some of the valuations of their mortgage servicing rights in the quarter that had an outsized impact. But for Wells, they're the mortgage behemoth. I think the overall patterns on volumes will probably turn out to be in line with what we see from the rest of the banks.
So, David, what do you do with the stock? Has it been punished enough for some of the fake account scandals and the results we're seeing, or not?
Sure. So we still maintain an underperform rating on the stock. We think there are other banks out there that have more upside potential. Our concern with Wells is that the fundamentals will continue to be inferior, and investors will look for banks that can grow revenue and grow the bottom line outside of some of the benefits from taxes and share repurchases. And when you look at a valuation perspective, the stock still trades at a premium to some of its bigger bank peers like a Bank of America, which we don't think is appropriate at this point in time.
Yeah, David, that was my next question. The week is still packed with PNC tomorrow, Mellon, BBT, State Street later in the week. Any implications in this result for some of those names that are still to come?
The results for Wells, some of it's specific to their struggles from the account opening fraud, but broadly speaking, I think net interest margins will continue to be under some degree of pressure. Going forward, we have deposit costs that are rising faster than the asset side of the balance sheet, and if the Fed does not raise rates like is in expectations at this point for 2019, those deposit costs will continue to accelerate and will put some pressure on bank net interest margins. And as it relates to the trust investment management fees at Wells Fargo, which were down, that will have an impact on everyone that has brokerage or any type of investment management business that will report this week, and we'll hear about that later on this week as well. So